Hey everyone, welcome back to the channel. This is LC. I will introduce another financial metric, Return on Invested Capital, ROIC, for measuring a company's capital efficiency. The purpose of ROIC is very similar to return on equity and return on assets. In many cases, especially companies in non-financial sectors, ROIC is preferable to ROE and ROA. In this first video, I will share definition of ROIC and how to calculate ROIC. ROIC is very similar to ROE and ROA, but is a bit more involved. The upshot is it gives the clearest picture of exactly how efficiently a company is using its capital and whether its competitive positioning allows it to generate solid returns from the capital. In a nutshell, ROIC measures for each $1 of debt and equity raised, how much in after-tax operating income does the company generate. Here is the formula. Net operating profit after tax, NOPAT, divided by invested capital. The name net operating profit after taxes is very descriptive, but you can also think about NOPAT as simple net income with interest expense at the back. We do this to figure out what the profit would be without taking a company's capital structure into consideration. To calculate NOPAT, multiply operating profit with 1 minus the standard tax rate. Invested capital is a non-standard measure where you won't find it on any standard financial statement. We have to calculate it ourselves. Invested capital tries to measure exactly how much capital is required to operate a business. It can be defined in two ways. First, operating approach. This is the amount of net assets a company needs to run its business. Starting with the asset side of the balance sheet, the calculation of invested capital begins with total assets, then reduced by non-interest bearing current liabilities, NIBCLs. NIBCL are basically all current liabilities that are not debt, with accounts payable often the most sizable item. The second approach is the financing approach. This is the amount of financing a company's creditors and shareholders need to supply to fund the net assets. From the liabilities plus equity side of the balance sheet, the invested capital calculation starts with total short and long-term debt and add equity, including preferred stock or any other equity-linked securities. Both approaches are equivalent since dual entry accounting requires that both sides of the balance sheet equal one another. Put in layman terms, whichever approach you use, it should yield the same result. Remember, asset equal liabilities plus equity. You should calculate ROIC using the asset side of the balance sheet if given the chance. The reason is that net assets approach allows you to see how efficiently the company is using capital. In contrast, the right hand side shows only how much capital the firm has and how it has chosen to finance the business. However, I personally use financing approach most of the time. Because I also apply other financial metrics that provide similar insights that offered by the operating approach. Let me show you one example. You can download the Excel file by clicking the link in the video description. In this example, we will calculate ROIC for high-O enterprise. Let's start with Notepad. The formula is pretty easy. Basically, we take the operating profit from the income statement times 1 minus the standard tax rate, 24%. Here, we get the Notepad. To calculate invested capital, as you can see here, there are two approaches: operating approach and financing approach. By using operating approach, we take the total asset minus total NIBCLs to get the invested capital. By using financing approach, we total up short-term and long-term debt plus total equity plus the deferred tax liabilities to get the invested capital. As you can see here, both approaches should yield the same result. Finally, Notepad divided by invested capital equals to ROIC. To recap, this slide shows the formula I am using to calculate ROIC. If you are veteran in financial analysis, you may wonder, where is the excess cash? Here is the complete version of calculating invested capital. Briefly, this version is not complicated. If you cautiously assign values from the balance sheet, you can get the invested capital easily. However, there is one catch here: excess cash. Excess cash can be defined as a cash a company has that is not required to operate the business. The idea is to include only the amount of cash a company needs to run its business. Some considerations include the cash a company needs until it reaches free cash flow break-even, the cash to fund all capital needs for 2 to 3 years, and the cash a company needs to run its business day to day. Of course, the proper number varies based on the nature of the business, its cash conversion cycle, earnings volatility, and where the business is in its life cycle. I don't really use this version because this version requires us to make so much assumptions to calculate excess cash. If you're really interested to see one example, you can download the Excel by clicking the link in the video description. That's all for this video. If you enjoyed the video, give me a like and share it out. If you didn't, a dislike. Subscribe for more, ring the bell, and I will see you in the next one.